Of the Financial Stability Report have just come out. That's been published by a unit comprising RBI, SEBI and Finance Ministry officials. And they have stressed that global stress has gotten higher while Indian macro stress has improved to medium from high. The report also dwelt extensively and minutely on corporate leverage and the bad loan problem. We have Latha joining in to explain all the highlights and the details to us. Latha, what are the takeaways?
Well, for one thing, it's an extremely detailed and well-analyzed report. Clearly, the amount of data available to the Reserve Bank and to the Finance Ministry, generally to the financial sector regulators, has vastly improved, and I'll come to that in just a bit. The important point is, first, the global risk. There are three risks that they point out, and that's not new to any of us. Financial market stress in China, monetary policy dilemmas in advanced countries where one wants to pull back liquidity and another wants to increase liquidity. And thirdly, global growth and trade remaining very anemic are the three risks that the global economy will visit on the Indian economy. And this global economy risks have gotten worse than previous year, because previous time you didn't have such a big stress from China, nor did you have these two divergent macroeconomic policies or monetary policies of the central banks. On the domestic side, actually the risk has gotten lower according to the report, though growth is a very big problem. The twin deficits and inflation are not the big problem, so macro risk has definitely decidedly lowered. But growth remains a problem because private consumption is not really picking up very robust, largely because of rural consumption. Private investment, therefore, is not picking up because consumers are not still biting. And therefore, that leaves only public investment as an alternative. And public investment can't go much because there are limits to policy. Now, the report stops as that there are limits to policy, which means, I mean, the hint is that there aren't too many rate cuts coming either, and there isn't much of fiscal headspace. So it just leaves that vague, but I guess monetary and fiscal space is not there, is what the report says. But the biggest contribution of the report is in the way it has analyzed corporate data. I have not seen such details in previous reports. Obviously, the Ministry of Corporate Affairs extensive data on 5 lakh companies is now available, as also, of course, the Reserve Bank's own CRILIC data, the credit repository data, is now available to the Reserve Bank on bad debts or stressed debt. And there, the Reserve Bank has come out with some extraordinary numbers. It says that corporate profitability improved marginally in September 2015 quarter compared to the first quarter. First quarter was clearly a fall in performance, but it has improved slightly in the second quarter on several parameters like profitability, margins, and return on equity. But an important sector of the corporate sector has shown increasing stress, and that is the over-leveraged and the weak companies. In fact, that is where the database has been used extensively. Just for the period ended September 2015, they have studied about 2,500 companies, I think 2,478 to be precise, and categorized 3 weak sectors. One are what they call leveraged companies, where the EBITDA cover to pay interest is less than 1. That is, you don't even have enough money, enough earnings to pay interest. Those are called leveraged companies. And then they have what they call companies where the debt equity ratio is more than 2. And then a combination of leveraged and weak companies. So what they have studied is that the leveraged companies, the number of leveraged companies in the total system have gone up to 19.4% from 18.4% year ago, as also that the number of highly leveraged companies has gone up to 15.3 from 13.6% year ago. The highly leveraged companies are, of course, those where the debt equity cover is over 3. Debt is 3 times equity. So the more important point for the regulator is that for these highly leveraged and weak companies, not enough money to pay their interest and still debt 3 times equity, the share, their share in the total debt of the system has gone up to 25%, 24.9% versus 22.9% year ago. So even year ago it was bad, but it's only increasing. So this is only part of the data that I'm reading out to you. The whole book is replete with such minute data on highly leveraged corporate borrowers who are accounting now for something like 78% of bank loans. So a lot of rich data on that. With respect to bank stress itself, they point out that gross NPLs have risen to 5.1%. Have risen to 5.1% in September from 4.6% in March, and restructured standard advances have declined. So restructured bad advances have actually increased. So total stressed loans, that is NPLs plus restructured loans, have risen to 11.3% for the entire system. And for the public sector banks alone, it has risen to 14.1%. So that's a substantial part. Almost 15% of the book is either an NPA or it is stressed because it is restructured. And they go on to say that, you know, the entire financial stability report is all about stress testing both the economy and the banking system. If they apply stresses, then the chances are that the GNPLs, the gross NPLs for the system could rise to as high as 6.9% by March 2017. That is under stressed conditions. And even their baseline condition is that the stress for the entire system, the bad loans for the entire system, is going to rise to 5.4% from the current 5.1%. So even with conditions remaining as they are, the amount of gross NPAs will go to 5.4. But if the macroeconomic indicators were to deteriorate, that is, growth even slipped, then you are going to have a rise of gross NPAs by March 2017 to 6.9%. And then there are further stress indicators. You increase the amount from standard deviation 2, standard deviation 3, then the stress for public sector banks goes up to even 11.9%. Well, I'm just reading out some of the data. It is replete with a lot of rich data. But with this little bit, let me go over to my experts. Shubhda Rao, the chief economist from Yes Bank, is with us. And in a bit, we are going to be joined by A. Prasanna, the chief economist at ICICI Securities, primary dealer, as well as Anindo Bhaumik of India Ratings. Welcome to all three of you. Prasanna, let me start with you. What are the chances that things will get worse? Because the Reserve Bank says as of now, the banking stress would go to 5.4% GNPAs. But if it was worse, if macros deteriorated, then it can go to 6.9. What is your sense? Does it get worse from here?
No, I don't think so. We see our base case is that things are going to improve, although we think that things are going to improve at a very, very slow pace. So if you ask about a stress scenario, I think the biggest risk is to the growth outlook due to some unforeseen events in the global economy. So that is the only scenario which we can foresee, because of which there is a deterioration in our growth outlook, which will, of course, mean that balance sheet health deteriorates further.
Okay. Shubhda, what did your take? I know you've not read the macro report and all you are reacting to are the flashes. They were embargoed, so we couldn't help you. But what the Reserve Bank stress report says is that global risk has actually increased and the Indian macro risk has actually improved from high to medium. Is that something you would concur?
Partially, yes, because definitely global uncertainties will continue, particularly emanating from China-related slowdown and its knock-on impact on the commodity space. I think that is going to continue for some time. Having said, I think, U.S. and UK economies doing better is somewhat of a point of relief. But in totality, the global uncertainties are not yet behind us. And we also have, divergent monetary policies in the developed economies. That also adds to the complexity in most of the financial markets. Having said, coming to the domestic risks, I quite concur with Prasanna that while from here on we see a gradual improvement, particularly, in the recent months, we have seen a series of policy announcements both from the Reserve Bank as well as from the government in systematically beginning to address the root causes of the bad assets, be it in infrastructure space or be it in commodity space. And more importantly, I would particularly cite the issues related to the discom companies.
Yeah.
So definitely, the process is well begun. It's not that within a year you're going to be able to resolve every possible issue, but the incremental stress I do not perceive to go up. On the contrary, I think it is going to get somewhat constrained and restrained systematic risks, I would think, on banking sector would begin to alleviate, would begin to recede at a gradual manner.
Okay, Prasanna, you know, the Reserve Bank is quite seriously worried about the risks to leveraged and weak companies. In fact, that is the interesting part of the data where they point out, I mean, they've studied only 2,400 companies for the September data, September 2015, but they've studied something like 3.5 lakh companies for data up to March 2015. Even over there, there is a problem of increased leverage, and leveraged and weak companies where the debt equity ratio is higher, you know, to the extent of 2:1, and in some cases 3:1, and where they are weak in the sense that the interest cover is not even 1. In these cases, the share of these companies in the total debt is as high as 30%, whether it's public listed or even privately held companies. Do you see this as a systemic threat? The Reserve Bank has numbers seem to indicate a fairly scary level of indebtedness.
So obviously, so this basically tells you that, I mean, as far as the banking system is concerned, at least, I think this NPA problem is going to be quite protracted, right? So if the rest of the economy or the corporate sector balance sheet is impaired to such an extent, obviously, which means that the improvement in banks' balance sheet is also going to take time. But whether it's going to become a systemic risk, then we have to see whether it's concentrated in some sectors. If that is the case, then it can become a systemic risk. But if it's so widespread, then I'm not sure. Then the risk is not so concentrated. Then whether it will add up to a crisis, I don't think so.
Well, actually, it is in a sense concentrated, according to the Reserve Bank itself, because they say the risk is obviously more in the public sector banks, where, as I read out the numbers to you, in the public sector banks, they recorded a stress of 14.1% by September 2015. For the system as a whole, it is 11.1. And obviously, by stress, they mean restructured plus GNPAs. But within these public sector banks, they say that 34 public sector banks with 12% share in advances showed low stress. But 16 public sector banks with 27% share in the advances showed a very high level of stress of over 16% for those banks. So is it that we are going to see some severe, sectoral failures, probably banks that will have to be merged or taken over in some fashion? Can it get as bad as that?
Yeah, so when I was referring to concentration of risk, I was more referring to the corporate sector in general. So since you're particularly asking about banks, so I think the lesson perhaps is that I think, and we have all been through this earlier in the 90s also, there was an NPA problem, right? And again, this is the next round of NPA problem we are facing. So I think one of the lessons is that even if this time we resolve it or over a period of time, because of growth, the problems get resolved, I think inherent in the system itself, there is this ability to keep generating fresh NPAs, right? And I think in the next cycle, next boom-bust cycle, again, we are going to be left with another NPA problem. One can almost foresee that, which means that fundamentally there is a problem in the banking system, in the structure of the system. And we all know what is that problem, right? I think it's public ownership of banks, the government ownership of banks. Yep. So unless that issue is addressed, I think this problem is going to continue.
To be fair, there are large discussions also on the quality of public sector ownership, as well as the way they are run. In fact, there's a very strong statement, and I'm unable to put my finger on, since this is a 200-page document. They speak about how public sector banks have to seriously look at their own capital structure, their dividend policy, questioning even whether they should continue to declare dividend at a time when they are making so much losses. That is the immediate problem. There is also a lot of discussion on the PJ Naik report and the extent to which it has been implemented. It's sounding very soft, but clearly we all know that the implementation has been far from satisfactory. Shubhda, it is not just a concentration of loans and bad loans within the banking sector in certain public sector banks. Even with respect to borrowers, there is a very rich set of data. For instance, it says the study, the report has studied the top 100 borrowers. And it says that actually the banking sector's exposure to these 100 borrowers has increased significantly from 17.8% to 27.6%. Credit to the top large 100 borrowers. And within this, the share of standard assets has actually fallen for these top 100 borrowers. It used to be 84.5%. It has now it used to be 86%. It has fallen to 84%. So both within the borrowers, there is a concentration of risk in the top 100 borrowers where there is higher weakness. And within the banking space, there are some banks which have shown higher stress. So do you think all this is pointing to a normal resolution of stress, or will it be something like a bad bank or something that will have to be created?
I'm not too sure, Latha, that bad bank creation would be a very good idea because
there's no money with this fisc.
Absolutely. I mean, you really are going to be, stretched in terms of the ability to create such. And to the point of top 100 borrowers and therefore, the exposures having gone up and simultaneously the standard assets ratio having come down, I think that's a phenomenon of growth, where wherever there has been a perception of growth, the top corporates have been, to whatever extent the appetite has been, the exposures have grown.
Okay.
But at the same time, these are the sectors whereby policy resolutions have been quite slow to come by.
Actually, Shubhda, we may have to redial because we have you on a bad line. Audibility is a bit of a problem. We'll try and reconnect with you. Dr. Pranab Sen, the former chief statistician and currently chairman of the Statistics Commission, is joining us. Dr. Sen, thanks very much. Well, among the first things that the Reserve Bank says is that while global risks have actually gotten worse, it has gone from medium to high risk. Indian macro risks have actually gone from high to medium, indicating improvement on the deficits front, current and fiscal, as well as on the inflation front. Growth, of course, is a question. Would you broadly agree with this assessment?
Yes, I would actually. The only issue is that if global risks go up, then our ability to withstand the aftershocks really depends on how well we manage our domestic economy. So in a sense, I think it puts a lot more responsibility on our policymakers than if we had a buoyant global economy.
Okay. And an important point they're making is, obviously the financial stability report is all about looking at the stress in the corporate sector and looking at stress in the banking sector. Macros itself has been dismissed probably in a page. A lot of stress and a lot of data is available on the corporate sector and in the banking sector. There, Dr. Sen, the Reserve Bank says that even in their baseline case, the gross NPAs of banks is going to rise from 5.1% to 5.4%. But if growth did not oblige, if India's macros deteriorated, FY17 was worse than FY16, then the total GNPLs go to 6.9% of total assets. Do you think that's a possibility? How high is that possibility of FY17 being worse than FY16?
Latha, you're speaking to a person who has lived through the times when the gross NPAs in India were 24%. Okay. So when you talk about 6%, it leaves me with a sense of optimism.
I think, sir. No, Dr. Sen, the optimism is misplaced. The optimism is misplaced because the word NPA actually covers only those that are declared NPAs.
That's right.
When you speak of the stress in the system, the Reserve Bank speaks about at least a 15% stress in the system.
Yeah. This is true. But, Latha, what you need to understand, that there's been a very fundamental change in the pattern of bank lending. And that is that earlier, a very, very small component of bank lending was in term loans. Today, the bulk of it is, in fact, in term loans. All right? Now, what it basically means is that the link between the GDP growth and the NPAs is not that obvious, because a lot of the assets that have been acquired through term loans are in the nature of capital assets, where you're looking at capital gains rather than at the flow performance of the economy. Okay? Working capital is directly linked to the flow performance. And the ability to service working capital. So there is a very fundamental change. And we still haven't really gotten our heads around how do we deal with it. Today, we know, for instance, and we've known for a long time, that legally there is an inherent discrepancy between the term structure of loans and terms of assets and term structure of liabilities. We've known this. We've created this. But we haven't really altered the banking rules to be able to address the problem.
No, that point is taken.
If we address it today, I think we'd be better off.
Yes, I mean, that point is definitely taken. A lot of, in fact, these long-standing malaise in the financial system, especially in the banking system, haven't been corrected. But the Anando Bhaumik of India Ratings and Research has also joined us. And I think, Anando, it is your community, the ratings guys, who are going to get milk the maximum from this financial stress report, because it's definitely qualitatively a superior report. The data from the MCA is available, and Dr. Sen knows how important that is. Those 5 lakh companies which the MCA has data for has been analysed threadbare for the FY15 period, and about 2,500 companies even up to September 2015 have been analysed. And here they say that there is a significant increase in the GNP ratio of the large borrowers among the public sector banks. It has risen from 6.1% in March to 8.1% in September. So it's actually the big defaulters whom all of us know, the top 100 borrowers, who are the guys who are actually stressing the public sector banks. I'll read more numbers. Standard assets among these large borrowers has declined from 86% to 84% from March to September, that is. Credit to top 100 large borrowers constituted 27% of the credit to all the large borrowers. This was again 17%. So banks have actually overexposed themselves to the top 100 borrowers, and those guys are creating stress to the extent of, I think the stress of these top 100 borrowers has increased to 3.1% from 0.7% of the total debt. In fact, there is a sharp increase in the GNPA of the large borrowers to 87% from 78%. So of the total bad loans, GNPAs of the banking system, 87% is accounted for just by these large borrowers. So no longer it is priority sector or agriculture which is creating the stress. It is these large borrowers who are really sucking the blood of the system. Anando, my question to you is, even if growth happens, do you think this stress goes away? Because these guys, as Dr. Sen pointed out, have a different kind of problem altogether. It is not even growth related.
It's not growth related, it's structural issues, and if the concentration is high, then obviously as long as these large entities continue to struggle, the banks would continue to struggle. And so therefore our view is through FY17 and 18, banks' performance, especially the PSU levels, are going to remain fairly subdued. We also did, Latha, a report a few months ago where we said that apart from these reported NPLs, amongst the standard assets, there are also entities that we believe are over-leveraged. And even if growth were to peak, like in, say, the Lehman days, pre-global crisis, even if growth were to peak and capacity were to be optimally used, say in 2 or 3 years' time, these entities would still struggle to meet their repayment obligations, because in our view their over-leverage, their extent of over-leverage is just too high. And we did a report which suggested that banks may need to look at haircuts of between 15 and 25% on a case-by-case basis. And we're talking of credits that are still not yet reported as NPLs. So apart from rising concentration and the growing NPL that the RBI report has pointed out, there's also the below-the-radar challenge of assets that are getting restructured, refinanced with the 525, but in our view are not adequately provisioned. Because of the belief of their fundamental viability, which I think is correct, but financially they would need some support, some principal write-down to be financially viable. I think they're operationally viable, but not financially viable. So the pressure is going to come from two folds. One is rising NPLs, which would remain sticky for a while, and also the under-provision on the standard assets.
Okay. Prasanna, do you think these have the makings of a crisis? On the one hand, if there is less growth, then there will be more stress. But as both Anando and Dr. Sen say, even if growth comes, for some of the large borrowers, the stress doesn't go away. And for some of the large lenders as well. So do you think for some segments of the corporate sector and for the banking sector, even the baseline projection is indicating a crisis?
So I would think policymakers have to be more focused on the banking sector, right? So because
Yes.
if you're talking about a crisis in the banking sector, then that means that it's going to take a long time to get resolved, and that itself will mean that growth will remain below potential for a long time to come. So essentially, I think it is about trying to locate, like you point out, whether there is a concentration of stress, and try and see how you can clean up the banking system. Of course, it means provision of capital. So again, perhaps I think the risk is whether the government, for example, as far as the public sector banks are concerned, whether they're underestimating the nature of the problem and therefore the amount of capital which is required and the kind of solutions which they have to put in place. So I think my point is, it could become a crisis if you underestimate the nature of the problem.
What, do you think, Anando, they are underestimating that 70,000 crores of capital which the government has promised over FY19 or up to FY19, would that suffice for the kind of problems the public sector banks face, especially those 34 banks which appear to be saddled with almost 27% of bad debt?
We think these banks would need double, if not 2.5 times that of the budgeted. And I think, and I'm fairly convinced that the 70,000 number would go up as push comes to shove. And some hard questions are being asked in 17. So this number, I think, in all probability would go up. It probably, our sense, it probably need to double or maybe even treble.
Final word from you, Dr. Sen. While for the macro economy and for the banking system, as you said, you have seen 24% stress in the 90s, and therefore these numbers will not look too bad. But for some banks, do you think that just throwing this 70,000 crore is not enough and something more systemic is needed to solve? I think for 34% of the system is what the Reserve Bank is saying.
Yes, absolutely. We have, I think, ducked the issue for too long. We've pretended that issue never existed, I think. And if this forces our hand and makes us take a good, long, hard look at the structural circumstances under which banks operate in India, I think we'll find that we do need to do, fairly significant structural reforms to our banking laws.
We have seen some green shoots in the latest IIP number. That 9.8, of course, was an exaggeration because of a very low base. But do you think growth will solve any of, or at least to a large extent mitigate? If the number of good loans go up, then the number of bad loans as a percentage at least looks small. But do you think at this point in time we can rest on that assumption or on that development?
Not necessarily. You see, the point, it depends entirely on what are the kind of assets in which the money has been put. My sense is that a fair proportion is in real estate.
Yes.
Until the real estate market wakes up, which it shows no sign of doing, they're going to continue to remain stressed.
Okay.
Because it's a cash flow problem.
Yes.
You can't
yes,
dispose the land off for anything now.
Okay, actually, it's not real estate. The big problem areas are actually iron and steel, construction and power, as they point out in terms of the most stressed borrowers.
No, they are the borrowers. They are the borrowers. The
Yes.
question is, what have the borrowers put the money into?
Money too, okay. Well, point taken.
That's the point.
Yes.
The point is, if they have put it into assets for expansion, which a lot of them have, so they've actually bought real estate, they can't get rid of it.
That's right.
If it were plant and machinery, it would be much more liquid. Real estate today is not.
Okay. Well, point taken, sir. We have to wind up this discussion. Dr. Sen, Anando and Prasanna, thank you very much. And Shubda as well. We couldn't reconnect with her. Thank you very much for joining us in this discussion. The key takeaway from the financial stress report is macros okay, global risks are high, and within the corporate sector, the top 100 borrowers and within the public sector banks, a set of 12 public sector banks are areas of very high stress, and that may not be cured even with good growth. That's a brief coverage of the financial stability report.